afternoon, everyone. Thank you for joining us. My name is TJ Armstrong. I'm a BDE in the Atlantic region. With us today, we have John Thanos. He's a Director of Sales Living Benefits with IA. And today, John will explore the child critical illness options available at IA and how to initiate the discussion with parents on this topic. Finally, John will review the importance of securing critical illness coverage as early in the child's life as possible.
TJ, thank you very much for the intro, and good afternoon, everyone. I don't think it's morning. It might be morning for some people out in the West Coast. So thank you for spending your time today. You could have been anywhere right now, but you chose to be here to learn a little bit more about transition CI and children. And the intro, my name is John Thanos. Many of you may not know me. I'm actually filling in for my colleague, Dennis Bannick. Great news for him and his family. His wife had two boys on Friday. So Dennis is off, and rightly so. He's got to be spending time with his family. So I hope you'll indulge with me a little bit in my presentation. I hope you find some value today. And before I go forward, I want to say thank you for your support for your business of Industrial Alliance. I really appreciate that. So just really quickly, I wanted to highlight a couple of things. And TJ, if I get a little choppy, let me know, and I'll turn off my screen, my face anyways, my camera that is. For those who don't know, IA is number one in a lot of things, and specifically critical illness. Now, I want to highlight that these numbers are as of Q3 of 2023, or maybe as of December 31st, 2023. But we are number one in critical illness sales. And what I mean by that is about 50% of all CI policies sold in Canada in the individual channel are purchased through Industrial Alliance. So very proud of that number, and I'm sure you'll find why. The reality is we're very flexible when it comes to our critical illness policy, but when it comes to insurance in general, we're number one in policies sold. That's life, CI, and DI, and we're also number one in claims paid in Canada. I would hope so. If we're selling a lot of apps or products, I'd hope we're number one in claims paid too. Number one in term premium as well. On the investment side, I'll say this real quickly, we are number one in gross sales for, I would say, probably about 8 years running right now. So if you haven't looked at our save funds, you probably should, because we're exploring, we're doing very well in that space. So what is transition? I get often asked this question as a wholesaler here, John, what is transition? What is it? I just need a CI product. It's just our branding. Our branding is called Transition CI, critical illness. And it is critical illness that fits every budget. Probably one of the reasons why we're number one in the industry, in Canada anyways. It is a comprehensive coverage with great flexibility and a lot to choose from, a lot of options available. And really, it offers you and your clients level and guaranteed premiums. So you don't have to worry about the future in terms of premiums going up and down. It's fixed, it's level, and it's across the board for transition CI. So when we're looking at CI, when you're talking to your clients, I'm going to talk to you about three types of clientele. And of course, we'll talk a little bit more about the children. I do have some case studies on that, which we'll focus on a little bit more later. But when you're looking at CI, you really want to target anyone and everyone who is relatively healthy. From birth to age 65 really is our qualifying period. But let's take a deeper look and show you where the opportunities are. So when we're looking at families, critical illness insurance, whether it's for mom, dad, or even the child, I know that's a focus today, very important. Oftentimes I get asked, John, why am I looking at insuring a child for critical illness? What's a $100,000 policy going to do? What's $50,000 going to do? I don't get it. Well, really, when you're insuring children, you're insuring the family. Because if a young child gets sick and is unable to, if a young child gets sick, chances are mom and dad or the parents will be taking time off work to care for the little one. And with that comes a loss of income, more than likely. So really what a critical illness policy does for a child, kid's not going to do nothing with that $20,000. He doesn't have to worry about anything really at that time other than getting better. But a critical illness policy for a family, for a child, I should say, will help the family out in the long run to ensure that the mortgage is paid. It'll avoid them from dipping into their savings. we always talk about we talked the game of investing for long-term capital appreciation. That's our RSPs. It's a purpose. It's our retirement fund. Of course, we have our TFSAs and such, but really what you want to do is we want to practice or we want to promote good behavior when it comes to financial planning. And critical illness insurance is one of the products that is well-rounded, a sound financial plan for a well-rounded portfolio. Yeah, and by getting children insured young, you get them insured at a young age, you get them low premiums, which is pretty, desirable. You want to insure travel expenses as well. When you're looking at insuring for CI, you have to worry about where the client is located. What if they're in a rural part of Canada and the closest hospital or facility is a couple hours or even longer in some cases away? So what a CI policy allows the client to do, allows them the freedom of making sure that they can get transportation to the medical facility, allows them the opportunity to, get accommodations. Maybe they have to stay in a hotel while the treatment is being rendered. And, just making sure that, they have what they need to be comfortable. One more thing I want to talk about really quickly is when we're looking at CI for anyone, we also have to look at alternative treatments. I'm in Ontario right now, and there's a lot of debate, I think, Canada-wide. I know it's happening big time in Ontario about our health system. And a lot of times there's waiting lists, there's a lot of things going on, there's a lot of challenges. But what the CI policy allows the individual to do is also allows them to, look at experimental treatments, alternative treatment plans located outside this country. There's a lot of ways we can treat cancer or we can look at it. Not everything is covered in OHIP in Ontario. I'll speak for Ontario. But the reality is there's other opportunities out there, and a CI policy can help with that. Early detection, understanding these things, or not early detection, but essentially treatment plans, right? And of course, supporting home support services or access to medical treatment, as I mentioned, not covered by our publicly funded insurance plans. Another group that we're looking at is millennials. Millennials are telling us that they do see the need to protect their income. They are finding the opportunity to talk to their brokers about life and CI. And really what they want to benefit from is, understanding a simple product. Maybe they want something real quick, real fast. We'll talk a little bit more about that later on so they can focus on their recovery. And last but not least, and I won't go into deep into this today, but businesses. Corporations have a responsibility to themselves, to their business. And I won't go deep into this, but there's a strategy called the shared ownership or split dollar concept. In short, it's essentially a corporation that pays a majority of the premiums using corporate dollars, where they insure the individual, the key person, usually the owner of the corporation, myself, and I would get return of premium, right? I would add that rider. The way the strategy works is majority of the premiums are funded by the corporation, and I, being John Thanos, the owner of my corporation, the insurance policy would be on me, and assuming I don't get sick, I'd get all that money back tax-free at age 65 or in 15 years. If I do get sick, the idea is that the corporation would get the benefit. So again, a topic for another day. It's very popular these days for corporations who are sitting on healthy, well-retained earnings and are looking for other ways to invest the corporate dollars in a way that's beneficial for everyone. So again, topic for another day. So let's take a look at the product. So here's a quick transition overview. We offer a 25 and a 4 illness product. I'll talk a little bit more about that later. So we have term 10, term 20, a term 25. Term 25 was unique in 2018 when we launched it. And then we also have some permanent options as well, including a T75, a T100. And then, of course, for more affluent and wealthier clients, we have a Quick Pay 10 and a Quick Pay 20. Now, you see the births and the ages there to qualify for these terms. When we're looking at insuring children, anyone under the age of 18, we can insure as little as $10,000 up to $500,000. And for anyone 18 and older, $10,000 to actually, I believe that number is now 3 million. I apologize. It's a little bit of an older slide. We can insure up to $3 million. Now, I want to stress, many of you know this already, so forgive me. For the newer advisors on the call, it's funny that oftentimes they get a call for a quote. The broker will tell me that they offered their client $1 million in term life, and they feel they need to offer $1 million in critical illness as well. And I tell them right off the bat, that's fine. I would love the opportunity to quote that for you, but it is going to be expensive. So I asked the broker if they've done their needs analysis. In short, CI is underwritten differently. It's priced differently from from life. So really what we want to do when we're offering CI to our clients is looking at, money coming in versus money going out. How much is the income earned? What are their obligations financially, mortgage payments, rent payments, car payments, food, etc. And from that, you want to work backwards by doing a full needs analysis and determining what the appropriate face amount is. Now, if you're going to go with a high amount of over 500,000, again, we would appreciate that. We love those sales opportunities. I want to stress for the broker, though, it's probably a good idea to include a cover letter of why you need this face amount. Cover letter can be simple, not too simple, but really what we're looking for is we want you to show the underwriters why the need for the higher face amount. Maybe the client's got a corporation. Maybe the child, if we're looking at a child who's under 18, if they want to do 500,000, sure, we can accept that, but we need to know why. Maybe the child's a prodigy and it's going to be the next rocket scientist. Things of that nature. Cover letters really help. So the illnesses covered, we have 25 illnesses. I'm not going to go through all of them. Many carriers have 25, some have 24, some have 26, but we also offer a 4 illness coverage, and that's unique, I think, for IA. So not only do we have 25 illnesses, we have the 4 illness product. It's more affordable. The 4 illnesses covered are the ones that are most claimed on in Canada. So a stroke, life-threatening cancer, heart attack, and of course, coronary artery bypass surgery. These account for about 85 to 90% of all CI claims in Canada. So something to consider if you're looking for an alternative, affordable solution. And we'll talk a little bit more about some strategies using a layering strategy later on. Let's look at kids now. Well, when we're looking at coverage for children, of course, we can do a standalone, and we'll talk a little bit about the riders. But for kids, all term and permanent options are available. You have the option of doing a 25 or a 4 illness product, as we said earlier. But what's unique about the children is we're also covering 5 additional critical illnesses up to age 25. So type 1 diabetes, muscular dystrophy, cystic fibrosis, congenital heart disease, and cerebral palsy. So when you look at that, if you have the 25 illness plus the 5, you're actually covered for 30 illnesses for the kids. And the idea behind this is, I mentioned again, I said it before and I'll say it again. We want to get the kids insured at a younger age because it's going to be lower premiums and they got more coverage, right? So again, doesn't matter the term or the permanent options available. They're all available for your clients, including the quick pay for the children as well. So some of the transition riders that are most popular, of course, return of premium upon death. It's available as a rider. It's available for both term and permanent options. If the client is looking for flexibility or return of premium where they get their money back, of course, we have our flexible return of premium, only available on our T75 or T100 is the flexible return of premium 15. So again, the client can get 100% of the premiums refunded in 15 years with the FRP 15. Flexible return of premium 65. This is available from birth to age 49 and available T75 and T100. And the client will get 100% of the premiums refunded back at age 65. And then, of course, we have a flexible return of premium 20, which is available for our quick pay 10 and our quick pay 20 options. So essentially, the client can get all of the premiums back refunded in 20 years with the FRP 20. Now, I want to highlight that many brokers think that they have to exercise the flexible return of premium at age 65, or they have to do it in the 15-year mark. You don't have to do it. It's just the options available for you there. In fact, if the client is still, relatively healthy and they're fine, they want to maintain their policy, they don't need to exercise at age 65. Maybe they want to exercise at age 70, or maybe, leave the policy in force and exercise it when the policy collapses at age 75. So it allows you flexibility, as I mentioned earlier. And in fact, my next slide will show you how flexible the ROP can truly be. We also have an increased benefit rider offered at issue only. And what the increased benefit rider does for your client, it allows them to have more insurance later on. And specifically, they can insure up to 50% of the basic face amount. So, for example, if the client had $100,000, in year 6, we can increase that face amount to $150,000. In year 11, we can do it again. We can do another $50,000. So the client in year 11 will be covered for up to $200,000. Now, let me tell you what this rider does. This rider simply bypasses any future underwriting. The client will still need to pay the premiums for the higher face amount. It really just allows the client to forego any future underwriting. All right, so just want to make sure we're clear on that. To be clear, to go a little deeper into the flexible return of premium, they call it flexible for a reason, because in specific years, you're able to take out an amount if the client wants to do so. For example, if you take the T75 and the client had an FRP 15, in 5 years, they can take out 15% of the available amount. In year 10, it's 50% of the available ROP. I want to stress, these are premiums, not face amount. These are premiums coming back to your client. In year 15, it would be 100%. But maybe your client wants to take money out in year 11 or year 12. The good news is the illustration that you produce through our software will allow the client to see how much ROP would be available in that given year. When we're looking at T75, we just scroll down a little further down on the screen there. T75, so the earliest the client can exercise would be at age 55, where they can get 15% of the ROP. Now, I want to reiterate, I believe the policy needs to be enforced for at least 60 months, which is 5 years, or it might be 10 years. I got to double check that. But again, the policy needs to be enforced for a certain period of time before the ROP is available. I don't know if there's a question there. We can take that now if you like.
I'm just going to read the question here for you.
Sure.
What are the tax implications with the early withdrawal?
So there are no tax implications. Now, let's just focus on an individual held policy. I'm not talking about a business shared ownership. Very good question. The benefit and the ROP is all paid back tax-free. Okay. Now, in every scenario, really, even if it is a shared ownership split dollar concept, but the shared ownership concept, there's some things that the client and their accountant and their lawyer have to do behind the scenes. I'm not presenting on that today, but in short, IA pays a benefit that is tax-free, and our ROP is also tax-free. So that would answer that question, be tax-free.
Thank you.
All right. Now, what happens, though, I want to be clear. If the client exercises their ROP in any given year, the policy will collapse, right? Whether it's 15%, whether they exercise in year 10, it's 50%, the policy will end. The coverage will cease to exist, right? If they do it in 15 years, 100%, again, it'll cease to exist. But what's unique about IA, and I think we're the only company that does this, is that we also offer a policy loan, much like you get a life policy. So now we got to be clear on this. The policy loan is only available if the client has ROP on death and the flexible return of premium. They must have both. So let me paint a picture for you. Let's just say that the client is ready to exercise. If they want to get 100% of the premiums back, but they're like, John, no, I want to just get a loan. I want to make sure that I still have coverage. Well, the reality is you can borrow up to 95% of the available ROP amount. So let's give it to you in round numbers. If the premiums accumulated over the years were $10,000, let's just keep it simple. If the client wants, he can borrow up to 95% of the amount, which would be $9,500, and maintain the CI coverage. Now, that's great because, as mentioned, if they exercise for the full amount, the policy will collapse. But in this case, they get a loan. Now, of course, the interest rate will be determined at that time when that happens. So I can't give you an interest rate, I should say. But again, allows the client flexibility. Why would they want to do this? Well, maybe the client is a business owner. Maybe they need to take some money out to, I don't know, fix a machine in their business or hire someone. They can do whatever they want with that money. And again, it's a policy loan that allows the client to access 95% of the available amount. We also allow the little grace period as well. So if the client has an NSF or maybe a missed payment or a default on premiums, we allow for an automatically policy loan. The premiums will be paid. So just to reiterate, the client must have ROP on death and flexible return of premium in order to take advantage of the policy loan. Now, let's take a little deeper dive into children now. Riders for children. Now, you can sell CI as a standalone for a child. I mentioned earlier the face amounts are up to $500,000. But maybe you're looking at insuring individuals right now, mom and dad or the family. If you're looking at adding CI as a rider for kids, we cover children from birth to age 20, and the maximum amount would be $20,000. Now, that is per child. It's only, as far as I know, it's only one premium amount. That's it. One amount, one rider for all children born into the family. Now, it covers unborn children as well. What I mean by that is when they're born, obviously it'll cover them. IA doesn't necessarily need to know that a new child was born into the family, but I would think that it's probably good practice to let us know, just because in the future there might need to be a change of ownership in case the child CI policy wants to convert that into another policy. So again, I don't want to blur the lines here. I just want to stress that for children, we can add a child CI rider to the husband or mom or dad, and we can insure them for $20,000. Or we can issue a CI policy for a child and have them covered for up to $500,000. Again, the CI rider is available on our CI policy for adults. It's also available on our whole life, our term life, and our par whole life as well. So could be added as a rider. Just want to stress that before I move forward. Renewal and coverage conversion privileges, much like any other insurance carrier out there, we're able to convert and renew, and you'll see the given ages there as well. So this product is fully renewable and convertible as well, much like any other carrier out there. Now, when we're looking at adding CI as a rider, so I know this presentation's on CI transition to standalone, but oftentimes we're approached with our clients saying, you know what, I just got a mortgage, I need a life insurance policy. So you're going to issue them a policy for $1 million to ensure that something happens, they're covered, the family's covered. But what I also like to position to my clients as well is, listen, we're going to protect you if you die prematurely. But what I'm going to do is I'm going to add a CI rider to protect you in the event that you get sick while you're alive. So we'll cover you while you're alive as well. So the cool thing about the CI rider is you got all the term and permanent options available. We have a 25 illness, we have a 4 illness product. Everything's available for you. The only thing that you cannot do, something just popped up on my screen. The only thing you cannot do is you cannot add the flexible return of premium riders to a CI rider. In other words, you can't add a rider to a rider. So if your goal is to offer your client flexible return of premium, you need to go with a standalone transition CI. Now, by adding a rider for CI to a life policy, what you're really doing is you're saving the client a little bit in premium. Well, not premium. You're saving the client the policy fee of $5 or whatever it is. So I just want to reiterate, if you're selling a life policy, you can add a CI rider. You can add the term that you'd like, transition 25, transition 4 illnesses, and it doesn't necessarily matter. You just can't add a rider to a rider. Now, all this time I've been talking about the 25 and 4 illnesses product. which is great. Now, this is nothing new. This is not a new product. This is nothing new, but what you're seeing on your screen is the Prevention Plus coverage. This is automatically included for every CI policy for transition CI. So what this does, it covers 7 additional non-life-threatening illnesses. Primarily, the most common ones are skin cancer, breast cancer, prostate cancer, thyroid. I'm not going to read them all, but the 7 are there. But what's unique about this is we'll pay out 15% of the face amount to a maximum of $50,000. So let me paint a picture for you. If you got a $100,000 face amount and your client gets skin cancer, we're going to pay out $15,000. Now, additionally, the face amount does not decrease. The face amount remains at $100,000. Theoretically, I hope this doesn't happen, but theoretically, the benefit could be paid up to 4 times. And what I mean by that is maybe one year the client has prostate cancer, stage A or 1A. So we'll pay out we'll pay out $15,000. Maybe next year they got bad luck, and they got thyroid cancer. That's another illness, another $15,000 or 15%. We can never pay twice for the same illness, but your client can theoretically be paid up to 4 times out of these 7 conditions. And the face amount does not decrease. So let me reiterate, $100,000 face amount has the potential of a CI policy claim payout of $160,000 if they're paid out for these prevention coverages. So hope that makes sense. Many companies are similar. They're catching on. They have similar coverages out there. Some cover 10%, some cover 15%. There is one company, I won't name them, of course, but they like to promote that they cover 8 conditions, which is unique, which is funny, actually, because if you look at my last one, gastrointestinal stromal tumors and neuroendocrine tumors, they have those 2 listed as 7 and 8. We have them together. So we're covering the same illnesses. It's just, marketing going on with them. But I'll never say anything bad about them. But, people companies are just looking at how to make themselves different. Medical second opinion. What can I tell you about this? I'll be very brief on this. Every CI policy sold with IA allows your client to get a second medical opinion on anything. Could be a sore wrist, maybe a sprained ankle, maybe it's a heart condition. And what I mean by that is, I don't know about you, but when I go visit my doctor, I know when he's having a bad day. He'll tell me, you go in and say, hey, doc, I slipped on some ice. My ankle's really swollen up. What do you think? Just ice it, John. Ice, compress, elevate. That's what he'd tell me. Go home. Okay. I know he's having a bad day because he would barely look at it, right? So I go back, I ice, compress, and elevate. It didn't do much. So, what I did, though, for example, is through MediGuide, I was able to call and get a second opinion. And they would share the medical information. They're very quick. They got the expertise of a lot of doctors in this world who might be looking at ankle injuries per se. And this doctor actually ended up providing me with a treatment plan of acupuncture. And man, oh man, did that work. Acupuncture is an amazing thing. So what I'm trying to say here is, if the client wants a second medical opinion on anything, they can call the MediGuide and get a second opinion. Now, it's only for the named insured. It does not cover everyone in the family at this time. Who knows what the future holds? But if I will say this, I'll end it with this. This service is rarely used. We talk about it, but it's honest to goodness, it's rarely used, but it is available for your client if they're looking at it. So let's take a look at a couple of sales concepts. And I got a real cool strategy called the 4 arrows strategy. I'm going to share with you a little bit later on, but let's take a look at a sales concept. So let's look at a child. That's what we're here for, right? Talking about children. Again, I want to reiterate, we're not insuring the kid. What's the kid going to do with $100,000? We need to put this in our clients' minds that we're insuring the family against lost wages, okay? But we're also looking at insuring the child for a long-term coverage with low premiums. So let's take a look at a sales concept. The sooner the better, because the premiums are a lot lower. So here's one. Let's take a look at this one. So grandparents, obviously, they can look at CI as a gift for their grandchildren or for more affluent, parents for their kids. So if we look at a quick pay 10 or a quick pay 20, so let's take a look. Newborn, 15 days after birth, the family decides to buy the child a quick pay. Grandparents are looking to do this for them. So they're looking at a T100 10-year, for $200,000. Return of premium on death is $30 a year. ROP is only, I got to double check those numbers, but yeah. So looking at total annual premium of $3,664. Not bad, not bad. Now, what happens in year 5, though, the potential return of premium would be about $2,800. In year 10, it's approximately $18,000. And by age 20, the ROP would be about $36,000. Now, the unique thing about this is the client can do whatever they like. At that point, the child's an adult. If he wants to take out the ROP, he can. Hopefully, they change the beneficiary and the policy owner at that point, and he can receive the ROP. Maybe he wants to use it for a down payment on a house. At this point, I want to stress that the policy is paid up, or he can continue coverage for the rest of his life and exercise the ROP maybe when he gets married at age 30. He can take that money back at age 30 or at age 50. You see where I'm going with this? The client's covered for life at this point because it's a quick pay, and after 20 years, the premiums are paid off. Pretty cool concept. It's not for everyone, but again, it's for the more affluent clients. Get them insured young with low premiums. Make sure to add the ROP on death and flexible return of premium. And in the long run, that child's going to benefit from A, from coverage, and B, from a return of premium from their gracious family or grandparents there. Now, I won't share my age with you. You probably have a feel of how old I am, but although I'm told I look a lot younger for my age. But when I was growing up, if we graduated from university or college, the thing to do back then was parents and grandparents would buy their kids a nice, shiny, fast car. Maybe a Camaro, maybe a Firebird. I never got a car myself, but anyways, I was just happy to have food on the table and a roof over my head when I was going to school. But what a great way, maybe, for that young adult who just graduated from university or college, what a great way for the grandparents or the parents to buy them a quick pay. Instead of that car, get them an insurance policy, have it paid up, and, show your family that you really care. Why give them a depreciating asset? I think that discussion is a long time old, since 1995 right now. And millennials know this already. They know the need for protecting their income. So again, another idea for you out there for your clients who are a little more affluent. Let's take a look at a quick case study. So look at Tyler and Lucy. Tyler and Lucy, they have 7-year-old twins, Sarah and Julie. They live in a town of about 2,000 people. So small town, rural Ontario or Quebec or anywhere in Canada. Both parents work full time. Of course, they have debts, a mortgage, a car loan, and of course, they got to put food on the table for these little ones. I don't get it. If they have 2 twins, why are they showing? Anyways, those look like boys in the photograph. But anyways, what would happen if one of these twins was diagnosed with a critical illness? Well, I can tell you, mom or dad or both will both take time off work. And with that will be a loss of income. How would the parents take care of their sick daughter and their healthy granddaughter? Of course, if they're in a rural town, they might have to travel to a facility or a hospital that has the facilities to get them the treatment. Could they take unpaid leave? I don't know. Maybe they are millionaires, but maybe they're not. Maybe they're working hard. Maybe they're like you and I, working hard every day to do what we can for our family and ourselves. So how would they pay their monthly bills? And, really what you want to do is I'm sure you're doing this already. I'm sure IDC has a lovely process in place for needs analysis. You need to do your needs analysis. You need to understand the money coming in versus the money going out. And I get it. Sometimes our clients don't want to tell us how much they're getting paid or how much income they earn. But what they really need to tell us is how much money is leaving them every month, every year. So, for example, the monthly mortgages with these ridiculous interest rates, and thankfully they are going down slightly, but not enough. Maybe they have a monthly mortgage of $3,000 a month. Maybe it's $4,000. So what's that a year? Let's do $3,000 a month. That's $36,000 a year just for the mortgage. And that's on the low end, I know. So right off the bat, what if the illness takes them out of work for a year? Whether it's the child, whether it's themselves, they have to worry about that. So let's round it up to $35,000. Expenses related to illness during the hospitalization. if because they're living in a rural area, they need to travel and maybe they're staying in a hotel close to the hospital while their child is getting treated. So you got to account for about $5,000 to $10,000 there. Maybe a little bit more if you're looking at alternative treatments outside of Canada. Childcare expenses for Sarah. Maybe they need to hire a nanny. Tutoring, expenses for housework and meal services. So again, all these numbers are accumulated to about $50,000 in coverage. One way, and there's many ways we can look at that. If a client, let's just say, if you leave the children out of this and just focus on the spouse, on the parents, maybe mom is earning $100,000 a year, maybe dad's earning $80,000 a year. Why not go with one time their salary as a face amount? And that way, that if they are off work for a year to recover, they at least have that benefit amount tax-free that they can use, right? What else was I going to say? There's something on the tip of my tongue. It just slipped my mind. Anyways, it'll probably come back to me. So let's take a look at some options. So here's some solutions for Tyler and Lucy. Well, we can do basic coverage. We do term 20, 25 illnesses, $50,000. That's going to cost $20 a month. I don't know. I apologize, folks. I don't know who this is on. I don't know if it's on Tyler or Lucy. But yeah, we're looking at $20 a month in this example here. Maybe we can do an extended coverage. So we can do a T75 with 25 illness for $50,000. But we can also do an increased benefit rider because we all know things will get a little more expensive as we get older. So we want to be covered for that. You're only adding a few more dollars a month at $26. So again, less than $1 a day for some type of critical illness insurance. Now remember what I wanted to say. The average Canadian loses approximately $17,000 in lost wages due to a cancer diagnosis. So there's no shame in offering your client $20,000, $25,000, $50,000 if it fits in their budget and if it gets them through the first few months of treatment. Or we can look at a premium coverage. We go a T100 20-year quick pay, 25 illnesses, $50,000 with return of premium after 20 years, with the return of premium on death, and we're looking at $55 a month. Again, it doesn't have to be super expensive. It could be very affordable. So why should you choose Transition CI? Well, I think, again, we're number one in the market because of our layering concept and idea. So we can, because we have a transition 25 illness and a 4 illness, you're able to structure a policy. It'll be 2 policies, but you're able to structure that in a way where we cover let me show you the next slide to see what I'm talking about. So a little bit of a busy slide here. Don't focus too much. Just look at the very top. So, for example, we can do a term 20 to cover the 4 illnesses for $100,000. Now, you can do this during the working years of your clients' lives, right? So maybe they're 25 years old right now, or 40 years old, I should say. Now you want to cover them until age 60. We're going to cover them for the 4 illnesses of up to $100,000. That's heart attack, stroke, cancer, and coronary artery bypass surgery. 4 of the top claimed in Canada. They account for about 85 to 90%. At the same time, we can also offer a T100 with the additional 25 illnesses for $50,000. Now, why would you want to do that? So now you have, for 20 years, the clients can be covered for up to $150,000. But let's just say they suffer a heart attack and they claim on the term 20 4 illnesses, they cover, it's $100,000. Boom, they get a paycheck for $100,000. But what might happen later on in life is they might have dementia, they might have go deaf, they might have blindness, they might have other, loss of independence, the ones that are covered under the 25 illnesses. Now, so they could, if they choose to, they can take $150,000 and that's that. But they can exercise the T20, get the $100,000 from the heart attack or the cancer, and then they can maintain the T100 for one of those illnesses that happen usually later on in life as we get older. Now, I've had a broker tell me, Johnny, I'm just going to take the whole 150 grand if that happens. So why even bother? But again, we're just providing your client with options. We talk about layering strategies for life. Why not do it for CI as well? So again, during the 20 years, we're protecting your client for the most crucial stage of their life, raising their family, getting their business going. And then, of course, the T100 will cover them in the retirement stages later on. So why we stand out is we offer no survival period for cancer. You really want to submit a claim the minute the client is diagnosed with cancer. They don't have to survive, but we want to get that money into that client's hand as quickly as possible. For stroke and heart conditions, there's still a survival period, I believe, of 30 days, just so you know, much like any other company out there. We have return of premiums that generate cash starting in the 5th year. The option to combine 25 or a 4 illness coverages for permanent and term products. I didn't talk about this. Decreasing 50% option. I'm sorry, I kind of brushed over that. I didn't talk about it. On the transition 4, let me go back a few slides here. I'm sorry, folks. So on the transition 4 illness, and only on the T10, the T20, and the T25, we offer a product that's more affordable. So it's a decreasing 50%. So what this means is, for example, you start off with $100,000 in T20 face amount. Over time, what's going to happen is that face amount's going to go down to $50,000 or 50%. And the reason why we developed this is because many of the policies that your clients are buying from the banks when they get a mortgage, their CI policy, it will decrease as the mortgage is paid off. So to stay competitive, we offer a decreasing 50% face amount to keep premiums even lower. Again, only available on the T10, T20, T25, and over time, the face amount will decrease to 50% of coverage. Affordable solution, not for everyone, but I'm sorry I didn't talk to you about that earlier. Now, so and as I mentioned, it's ideal for those people who are in the mortgage market. Possibility of taking premium holidays thanks to the automatic policy loan option. So if you have the ROP on death and flexible return of premium, you can take a holiday if you need it from premiums, should the client need it, or if they need a loan. Increased benefit rider, which offers a protection that stands out for your young professionals. You know, we know that our health changes over time. So the increased benefit rider allows the client not have to go through any further medical underwriting. And a quick and easy application process thanks to EVO, which I'm going to talk briefly about that in a second. I think there is a quick question there. I'll go ahead and take that if that's all right.
Should a client die while the claim is being processed with no survival period illness, would the face amount still be paid or the ROPD kicks in?
A very good question. So that's a very good question. Thank you for that. So if it was cancer and the claim was submitted and the client dies, I don't know, 10 days after the cancer diagnosis, the benefit will pay. So long as the claim was submitted, so long as everything's fine, right? The claim will pay. Now, the problem is at that point, the claim's going to be paid to either the client's estate or to a beneficiary if there's one set up. But the answer is yes. Yeah, so that's for cancer. Now, if the question is surrounding heart attack, if you submit the claim, the client suffers a heart attack, the client dies in the 20th day, then no, it would be a return of premium being refunded if he had ROP on death. I hope that answers the question.
Thank you.
Thanks, TJ. And hey, folks, I just want to show you, whoa, why is that bubble like that? I don't like that. Let me fix that now. There we go. There we go. So I want to show you how transition is truly adapted to fit all budgets. So if we look here, we got a 35-year-old male non-smoker. So, if we're looking at the 4 illness product, look how affordable this could be. As low as $14 a month if you go with a T10. And if you want the quick pay with all the RLPs, etc., you're looking at about $93 a month. So this could be anywhere in between. Now, obviously, you might want a T25, you might want a T75, but I just want to show you the scope of how this could be. If you want the 25 illnesses, not much more expensive. Want the 25 illnesses, we're a little bit more expensive at $21.40 a month versus the 4 illnesses, but we're covering, obviously 21 more or up to $114. So again, want to show you how affordable it could be. Again, I mean, I'd love the $3 million face amounts. They don't come across very easily these days. There's no shame in offering a $50,000 policy if you get your clients through, the tough times. So this is the holy grail of all slides. And then I want to share a quick strategy with you, and I hope you find value in what I'm going to share with you. But this is the whole slide here. So in brief, so whether you want 25 or 4 illnesses, you have the term and permanent options available for you, as you can see. Transition CI is available from birth to age 65. We cover 5 additional critical illnesses for children. It includes a prevention plus benefit, which covers 7 additional illnesses, and the medical guide, or the MediGuide second opinion. Now, flexible return of premium is only on the T75 and the T1. No worries. So this is shared with me by one of my colleagues out in Western Canada, and I really love this strategy because it's a conversation starter. It's really what it is, a conversation starter. So let's take a look at life. If we look at the very bottom, we have our 25 up to age 65. If we look on the left-hand side of the screen, we have the income earned, and we'd like to think that as we get older, we like to hope that our income earns as we become professionals in our jobs, and we find more growth opportunities in our careers and what we do and who we are, right? So we have to ask yourself, I ask my clients, let's explore, when is your income at danger or at risk? Well, the industry has defined, we have 4 key areas, right? There's disability, there's illness, there's death, premature death, and of course, retirement. You're probably wondering, how's my income at risk when I'm retired? We'll talk a little bit more about that. So 4 key areas of risk that you are all licensed in to offer your services in managing risk and ensuring the clients are taken care of. So the good news is many of your clients may have some of these benefits through their employer. Maybe it's a disability plan, maybe it's whatever. But when you're looking at business owners, they really don't have anything. And they're really, truly relying on you to walk them through. So let's take a look. What does history tell us? If we look at 100 people, what will they face between the ages of 18 to 65? Well, 1 in 3 entering the workforce today in Canada will be disabled during their working career. Now, I don't know how long. Maybe it's 2 weeks. Maybe it's 4 weeks. But the point is, disability does happen. It happened to me, happened to people I know, and it probably happened to people you know. An illness. We basically have a 1 in 4 chance of developing some form of critical illness in Canada. In fact, I would say that number is a little riskier. I think 1 in 2 Canadians will develop cancer in their lifetime, which is a pretty strong, scary number if you think about it. Death. We have about a 6% chance of dying prematurely. Now, I can't speak for everyone here, but in Toronto, I'm in downtown Toronto, and I can tell you how oftentimes I see people walking across the street with their cell phone right to their face, not looking across to see cars. Now, I'm not trying to be funny or anything, but it's true. Like, unfortunately, you turn on the news every day and you see people dying. You hear about the tragic accident. It happens, unfortunately. And last but not least, 83%. What is that number? 83% of Canadians will be relying heavily on government programs, whether it's CPP, old age security, for their retirement. So clearly, a lot of work needs to be done in this area for retirement planning. Now, the question I ask my client, what happens to your income in all of these circumstances if you suffer from one of these 3? Well, we know if you're dead, you're dead. There is no income. But here's where the 4 arrows come in. Your income goes down. You're not able to work if you're disabled. You're not able to work if you suffer a critical illness and you're getting cancer treatment. Or maybe you are, I don't know. If you're dead, you're dead. If you die prematurely, and then that's unfortunate. It's always bad for the family left behind. Hopefully the client had a life insurance policy. And retirement, 83%, as I mentioned earlier, are having a tough time. They're relying heavily on government-sponsored programs or government and retirement programs. And we know, those, are they even indexed? Are they going to have coverage, interest rates when things go up? Life is hard. So if the client is reluctant and they say, no, I'm Superman, it won't be me, I take care of myself, okay, that's fine. Well, that's your responsibility without an advisor. And what I mean by that is your responsibility to your family, because you don't want to take this discussion about critical illness to the next step. But really what we want to do is we want to make it our responsibility with me as your financial advisor. This is what I do. This is what you do. You manage risk. You take care of people with life, DI and CI. And you handle them, you walk them through the process and ensuring that we're taking care of the family for generations to come, really, if you're looking at life insurance at the very least. So help better understand, Mr. Client, which one of these arrows or triangles are you most at risk for? Disability. Are you working in an environment with a high risk of accidents? You might want to look at disability insurance. Critical illness. Is there a family history of you and your family suffering from CI? Let's get you insured now before you are uninsurable. Death. I don't know. I hate to say it, but we all have family members who die at a premature age. They die young. Maybe we get you insured so the same doesn't happen to you, so that when you do die, if you die prematurely, that your family's taken care of. And retirement. Look, I do this every day. I can help you with seg funds. I can help you with guaranteed issue products. Guaranteed investments, whatever the risk tolerance is. And by looking at this slide, by going through this with your client, everyone has their own style, their own focus. You're able to manage. You're talking about 4 key areas that you're licensed to sell, and you're covering every one of these. So I hope you found some value in this. I really love this, and I'm so glad that my colleague shared this with me. Now, we ain't nothing unless we're paying claims. And I only got 5 minutes, so I'm going to wrap this up real quick. I want to show you where the most claims are being paid. Since 2000 till 2021, IA paid out nearly $170 million in claims for CI. I call this the danger zone, and that's the ages of 40 to 59. These are the years we're earning our income, doing well, raising our families, and to some degree, when you're in your 50s, you're raising your grandchildren, right? So we want to ensure that we're insured during this time. The average age of a CI claimant is 55. These are where the claims are being paid out the most. So some sales and tool support for you. I'm not going to go through too much details, but there's a lot of stuff available on our software, on our the Advisor Center. But when we're looking at Evo, the application process, and I'm sure Dennis will spend more time with this you down the road. Evo is our software to submit business electronically. It incorporates artificial intelligence. And I forgot to mention, for anyone who's under the age of 50, who's looking for a CI face amount of $200,000 or less, there are no medicals required, just a declaration. And assuming the client is healthy, they're good to go. Now, depending on what's discovered in the declaration, there might be further underwriting required. But under 50, less than 200,000, there's no medicals required. I will say this: if you want the 25 illness product, there's 18 questions to qualify. If you want the 4 illness product, there's only 8 questions to qualify. So again, we make it real easy to get you through that. Wow, lots of tools available for you here. You can go online to the Advisor Center. We have product summaries. We have got product guides. We got an advisor brochure. We got a client brochure, case studies. We got millennial brochures for the family. We also have brochures in other languages besides English and French. We also have, I believe, Mandarin and Punjabi. And I believe we're working on other ones as well. So depending on your target market, we have almost something for everyone. We have email templates customized to concept for you if you want to share it on, social media, etc. Lots of things to go through, and I'm sure Dennis can walk you through that some other time. And with that, guys, I'm at 1:59 Toronto time. Hope I didn't talk too much.
No,
Sherry,
that was great. I mean, I think John found out today that he was presenting for this webinar. So great job, lots of energy. We really appreciate it. Thank you to our advisors who joined us and everyone who helped organize this. Just a quick reminder that this will be posted on the IDC Win Big site by next week. So if you wanted to check back on anything, please feel free to take a look. I think that's it. CE credits, I think, are under review. So maybe check back in a few days and we can let you know on that as well. But again, thank you, John. Thank you, advisors. Have a great day.
Thank you, TJ. Thank you, everyone. You guys have a great day. Thanks for your time.